Last Christmas, JEPY didn't exist. This Christmas, JEPY will exist and it will be paying out dividends. Let's take a closer look at Defiance's S&P 500 Enhanced Options Income ETF, the first ever ETF to have put-right daily zero-day options to get income that gets paid out monthly. This is everything a dividend investor loves. JEPY is currently boasting an annualized yield of 59.21%. Is this real life or is this Mickey Mouse dividends? Just like I explained in my QQQY video, just because this fund has done really hot for a little bit now, that doesn't mean it always will. And having a 60% yield is not a free lunch. As with investing in anything in the stock market, it's all about finding the right balance of risk versus reward. A 60% yield carries risk regardless of what other YouTubers are telling you, so let's dig into why this is. So zero-day options are speculative because there's very little time for the underlying asset to make significant price movements in your favor. But there certainly is the potential for losses, more than the premium we're getting paid back to doing those zero-day options. This fund gives exposure to volatility, and impacts of news events can quickly bring down the market. That's why I don't really view funds like this as investing, but more so as speculation, as it feels more similar to gambling. This is coming straight from the fund's prospectus. I encourage every investor to actually read those before putting 100% of their portfolio into these funds. So every day the fund is going to be selling put options. They're either going to be at the money or 5% in the money, which essentially just means they're going to be higher than the current market price. The fund's potential for profit will fluctuate. Generally, they will try to get a return of 25 basis points each day. That's a really good return. Some of the perks of this strategy is that doing the zero-day options, that can have much juicier premiums than doing weeklies or monthly options due to the short-term nature. Plus, investing in JEPY provides the opportunity for monthly income that is not dependent on the price appreciation of the S&P 500. But the prospectus is very clear. Investing in JEPY is not the same as investing in the S&P 500. Because the fund is doing zero-day puts, it's going to limit its potential gains if the index increases in value. There's absolutely no downside protection. So if the fund goes down several percentage points, in one day, JEPY is going down swinging with a bullet. You can see how quickly this can become a problem if all the downside is there, but the upside is limited. Those black swan events that investors don't want to think about, they're going to happen inevitably. And generally, over long periods of time, the market will recover from black swan events like that. But with JEPY, that recovery is being capped with the options trading they're doing. JEPY would be ideal during sideways markets. JEPY also holds cash and treasuries for collateral purposes. They also do this to provide some income, but that's also going to be tied to interest rates, just like everything else in the world these days. But the vast majority of those monthly dividends, those are going to be coming from those put option contracts in the form of premiums. That's always going to fluctuate based on the volatility of the index. That's another aspect investors have to be okay with, is the variable dividend payments. Unlike most quarterly paying companies where you have a really good idea of what the next dividend payment will be, JEPY is always going to fluctuate. So far they have paid dividends of 90 and 91 cents. But there's going to be months where it's going to be much higher than that, and there's going to be months where it's going to be much lower than that. That's all going to be based on the volatility for that month. The fund price will also go down the amount of the dividend on the ex-dividend date, as they are now worth less since they're having to pay out that distribution to you in the form of dividends. Dividends are also never guaranteed, and the fund is never obligated to pay you a dividend. Just like anything in life, nobody owes you anything. Both of these factors would have me nervous if I was in retirement, where you often have relatively predictable expense costs that now need to be juggled with variable dividend payment. Also, the fund does have a very lofty 99 basis expense ratio. That is definitely expensive compared to a passively managed S&P 500 fund, but this is an actively managed fund. The strategy is a little complex, so I totally understand why it needs to be higher, though just know that's more money that's being taken out of your pocket. JEPY has been around for about 2 months now, and without dividends, it's actually doing slightly worse than the overall market at negative 4.32% compared to negative 3.33%. But if you reinvest those dividends, they're actually almost exactly the same, both even at around negative 0.47%. Now, I keep hearing people say to protect against NAV erosion, you should really invest back all the dividends. But isn't the whole purpose of these ETFs to live off of the dividends one day? Wouldn't that kind of defeat the purpose if we're just reinvesting them? Distributions are also going to get that unfavorable tax treatment, generally taxed at your highest income tax bracket, unless they're held in a retirement account and shielded from taxes. So investors, do I love JEPY? I'm going to have to defer the same way that I felt about QQQY. It's more of a speculative ETF than a true investment. And yes, while this trading strategy has existed for decades and has made people quite rich, it's also made people quite poor as well. I would still like to see how this ETF does in different interest rate environments, different market conditions, black swan events, bull runs. It's hard to predict how well this fund will do when it's only 2 months old. Now, does that mean these Defiance funds have no place in your portfolio? Absolutely not. Once again, a big part of investing is balancing risk versus reward. If one had a small percentage of their portfolio for more speculation, more power to them. In fact, JEPY is growing in popularity. It's now ballooned to $64 million in assets under management and growing every single day. More and more investors are pouring money into JEPY. I think a lot of new investors are definitely brought in with the allure of that massive 60% dividend yield. Let's just see how consistent they can keep out paying those big dividends. Its even more popular brother, QQQY, is now up to $151 million in assets under management. Where I lose faith in humanity is when people put 100% of their portfolio into income ETFs, expecting a free lunch. I had a person enter my Discord. He was 80 years old, and he had 100% of his portfolio into QQQY. I tried explaining to him that these funds are risky, and going 100% into anything is not smart in the slightest. He resorted to rambling about all the potential benefits of income ETFs without once acknowledging any of the risks, or how he had watched interviews with the fund manager and how it seemed like a good investment. Well, yes, of course, the fund manager is not going to use their time on CNBC to be talking about the downsides of their fund. They're obviously going to be pitching their investment by highlighting the benefits. The 80-year-old kept insisting that I was the stupid one for not seeing how easy getting a 60% dividend yield was with no risk every single year. Yeah, he couldn't answer my simple questions, such as, if it's so easy, why isn't Warren Buffett, the greatest investor of all time, putting his $100 billion plus portfolio into these funds and getting a 60% yield every year? Why isn't this mainstream news that, hey, you could recover your entire investment in just 2 years with this fund? Why are you the chosen one that has found the magic beans investment? Why can't you answer any of these questions? It's almost as if there are some risks associated with the strategy that people are just not understanding, even though Defiance makes it very clear on their website all the associated risks. This year, to save you from tears, don't be the 80-year-old. Don't be so close-minded, only exposing yourself to people that think like you. Don't put 100% of your portfolio into a speculative ETF. And be prepared to get destroyed with facts and logic if you come at me in the comments or in the Discord. I'll take on any income ETF fanboy any day of the week. Healthy discussion and dialogue is the key to learning. If you want to learn more about an ETF that has returned over 8,000% since its inception, check out the video right here on TQQQ. Leave a like for the algo. Let me know your thoughts on JEPY in the comments below. My videos are always found in podcast form under the Collect Cash podcast name. and I'll catch you on the next one.